Let's talk, well, potentially a bit of a defensive sector, the insurance sector in particular, and for his top picks and an overview of how it is performing more broadly, Chris Haynes, from Head of Australian Equities at Equity Trustees Asset Management, joins me live via Skype. Thank you so much for your time. Really appreciate it once again, Chris. I mean, a lot of the kind of, analysis I read around the insurance sector is that perhaps it's a sort of an underappreciated defensive play in the market in times like these. I mean, would you be generally sympathetic to that view?
Yeah, look, insurers can be pretty boring and defensive and not very exciting. You know, there's a lot more exciting things out there, but I think we're in a period for insurers now which doesn't happen very often. So a 1 in 20 years sort of a cycle we're in. So we're in a pretty hard tightening cycle. So that's been going on globally, and QBE is a beneficiary of that. But that hasn't really started in Australia really in the last 6 months. That we've seen those pricing increases put through. So we're seeing very, very strong price increases put through the books of both Suncorp and IAG. And, also at the same time, we've seen that industry consolidate in Australia. So we've also had CBA and Westpac exit those sectors and sell those businesses off. So it had consolidation as well. So there's no pushback on price increases. So I don't know if you've looked at your insurance bill, but I got my home contents the other day. That was up 60% on last year. We're going to, I think if you survey anyone, I mean, it's one of those ones where you can see things, day to day talking to people. But 30% increase is the norm, and both companies have come out in the last result, and IAG was a little bit disappointing, but they do talk about the book being repriced around low double digits, but we think that's going to be a little bit better than that. Now, I could be jinxing myself because IAG's got an investment day later on this week, and there may be some weakness around claims inflation in New Zealand. But we think, looking 15, 18 months out, things look pretty good for both of the companies. And we're seeing some fall off in the claims inflation, which obviously is an important bit. So we've seen some goods inflation come down, and we think pricing around that is a little bit more easing for the companies, but those price increases will really flow through to the bottom line. And in addition, we're going to have a reasonable return on those investment books, so the capital that they hold, and that's a positive as well. So yes, it is a bit of a defensive sector, and but it really is a bit of a purple time for them at the moment.
So can you I know you've touched on it briefly just there, but what's driving premiums higher in particular? Because I know that there's depending on which area of the sector we're talking about, it can be kind of idiosyncratic, but is there some common threads there, some common themes that we can identify that, is really driving this, in a way, pricing power for some of these insurers?
I think just one of the factors is we had a very difficult weather season last year, so we had a lot of claims. So I mean, force up prices. So and the beautiful thing is we had consolidation in the sector. So no one's really looking to get market share. Everyone wants to make money. So they're probably the two key drivers around that being able to they want to put prices up. They can put prices up, and no one's looking for market share. I think when you have a lot of claims, also you find out the companies that don't pay the claims, and there's a few issues in that respect. So I mean, ASIC has taken one of the insurers, not the two I've mentioned, but in the domestic market. So not paying claims, people go to the bigger companies, so they have some surety around being able to make claims and getting them paid.
So how long do you think these conditions could potentially last? Because, I mean, is this something that is sustainable and, offers a long-term investment opportunity here? Or is it kind of more of a situation of, making hay while the sun shines here, especially, again, if, you're looking for just a short period of defensiveness in your portfolio?
Yeah, I think, Carl, we'd be happy for the next 18 months as those things roll through, those price increases roll through the book. Usually when prices are too high and they earn too much money, capital flows back into the market. So yeah, it's not a, it's not a 5-year call, but things look pretty good over the next 12, 18 months, I think.
So what about in the longer term too? Because I mean, I had a friend of mine who worked at a very low level in terms of the insurance world, and the constant refrain is that, well, premiums are never going to go down, for example, and there are all sorts of structural incentives to make sure that you take out insurance, for especially in Australia. The flip side of that, though, is there's often talk about the greater risk because of extreme climate events and having to pay out more to cover insurance claims. So what are some of those bigger picture things that one should consider when looking at the insurers?
Obviously, claims are a big issue. So we've just gone through La Nina. So the claims during La Nina are, there's some research around that says that they're double what they are during El Nino. So that's something to consider just in the short-term cycle. Those longer-term issues around climate change, there's a lot of other factors involved there, where you build your houses and, how you structure you put your infrastructure. So they're longer term issues. I don't think we'll get a head around those. But at the end of the day, the companies will price for that risk or for that what you're asking for. So you're going to have to pay one way or the other.